Hey there, savvy investors. Ever wondered how inflation quietly nibbles away at your hard-earned gains? Stick around, because today, we're uncovering the hidden impact of inflation on your investments. And trust me, the most important point is coming up. It's a game changer. But first, what is inflation? Simply put, it's the gradual increase in prices for goods and services over time, eroding the purchasing power of your money. Now, how does this affect your investments? That's where things get interesting. Have you considered what happens to your investments as prices rise? Do they keep pace with inflation, or does your money lose value over time? These questions might seem simple, but the answers are crucial to securing your financial future. Keep this in mind, the most important point is about to hit home. Picture this scenario: you've diligently invested for years, but without accounting for inflation, those gains could vanish faster than you think. So, how do we protect against this silent threat? Let's find out. Impact of inflation on investments. Understanding inflation's impact on investments requires a deeper dive. Imagine you've invested $10,000 in a diversified portfolio. Over time, inflation averages around 2 to 3% annually. This seemingly small percentage compounds over the years, reducing the real value of your investments. Inflation erodes the purchasing power of your returns, meaning that if your investments aren't growing at a rate that outpaces inflation, you're effectively losing money. Strategies to combat inflation. So, how do you protect your investments from inflation's bite? The key lies in choosing assets that historically outperform inflation. Stocks, for example, have historically returned around 7 to 10% annually, which can help offset inflationary pressures. Real estate investments, especially in growing markets, can also act as a hedge against inflation by potentially increasing in value over time. Commodities such as gold and oil have also been used historically to preserve wealth during inflationary periods. The role of bonds and cash. While stocks and real estate offer growth potential, bonds and cash have their place in an inflation-resistant portfolio. Bonds, particularly inflation-linked bonds like TIPS, Treasury inflation-protected securities, adjust their principal value with inflation, ensuring that your investment keeps pace with rising prices. Cash, while not yielding high returns, provides liquidity and stability during economic uncertainties, acting as a buffer against market volatility. Long-term investment strategies. Investing for the long term is crucial when combating inflation. Dollar cost averaging, where you invest a fixed amount regularly regardless of market conditions, can smooth out the effects of market fluctuations and inflation over time. Rebalancing your portfolio periodically to maintain your desired asset allocation can also optimize returns while managing risk. Remember, the goal isn't just to beat inflation but to preserve and grow your wealth steadily over the years. Case studies and real-world examples. Let's look at a real-world example. During periods of high inflation in the 1970s, investors who held diversified portfolios with exposure to inflation-resistant assets fared better than those heavily invested in cash or fixed-rate bonds. By diversifying across asset classes and staying invested for the long term, you can potentially mitigate the impact of inflation on your wealth. Here's the most important point. To protect your investments from inflation, diversify your portfolio across assets that historically outpace inflation. Understand the risk-return profile of each investment and adjust your strategy based on your financial goals and risk tolerance. Don't forget, staying informed and adaptable in changing economic conditions is key to long-term financial success. There you have it. Insights into how inflation impacts your investments and strategies to navigate these challenges. Have you considered the impact of inflation on your own portfolio? Share your thoughts and questions in the comments below. And if you found this video helpful, don't forget to like, subscribe, and hit that bell for more financial insights. Until next time, stay curious and invest wisely.